They said Bitcoin's unstoppable momentum had fizzled out, that the once mythic rally was fading into the shadows forever. But here we stand, staring at what could be one of the most pivotal weeks for the entire crypto universe, wondering if we are on the brink of another surge or staring up at the last plateau before the roof caves in. Today, we dive into a whirlwind of developments that promise to shake the digital finance world to its core, from the surprising twists in United States non-farm payrolls data to the high-stakes pulses of the OPEC Plus meeting, looming tariff deadlines, and the often underestimated token unlock phenomenon. But what is really happening behind the scenes? And how could seemingly unconnected events like oil production agreements in the Middle East or the latest shifts in American hiring numbers possibly determine whether Bitcoin bursts past 107,000 or collapses under the weight of global uncertainty? In this deep dive, we will unravel the fascinating chain of events that ties worldwide job markets, major production cartels, political maneuvering, and crypto supply expansions into one big mosaic of opportunity and risk. We will go through four major turning points in this epic tale: the all-important United States non-farm payrolls data release, the OPEC Plus gathering that could rock energy prices, the approaching deadline for tariffs that might supercharge or deflate market optimism, and the wave of new tokens preparing to flood exchanges and test investors' nerves. By the end of this journey, you will see exactly why every fraction of a percentage point in job growth or a subtle shift in a commodity meeting can send ripples, and sometimes tsunamis, across Bitcoin and altcoins alike. Before we explore each of these catalysts in detail, let us set the stage with one arresting truth. Bitcoin, for all its fame as the king of cryptocurrencies, has recently been struggling to break through that elusive resistance level at 107,000. It is just as if a glass ceiling has formed, defying all attempts by bullish traders to push the price higher. Meanwhile, altcoins have been on a kind of roller coaster, some plunging in value while others refuse to surrender, all while the total crypto market cap hovers around $3 trillion. Why this standstill? And more importantly, how can traditional economic indicators possibly meddle in the fate of a cutting-edge digital marketplace? That is what we will uncover. In this episode, we are pulling back the curtains on each chapter of economic drama, showing you how it all works, why it matters, and whether the unstoppable Bitcoin dream might triumph over every skeptic's dire warning. First, though, let us talk about non-farm payrolls data, quite possibly the single biggest macroeconomic statistic that sets the tempo for the vast majority of financial markets in the United States. On the surface, you might think, crypto is outside the boundaries of conventional government data releases, right? But the reality is more delicate. Over the years, analysts have seen crypto markets, especially major coins like Bitcoin and Ethereum, react with startling intensity to interest rate rumors and job reports. When those monthly figures come out showing how many people got hired in the preceding weeks, it can be a direct measure of the economy's health. If the economy is robust, the Federal Reserve might be more comfortable raising or maintaining interest rates, which can dampen the availability of cheap funds for speculative investments in digital coins. In contrast, a lower than anticipated jobs report might hint that the economy is weakening, which often compels the Fed to consider interest rate cuts. And interest rate cuts often set the stage for more adventurous investment in riskier assets, including cryptocurrencies. Now, on the first Friday of every month, we get this pivotal data: the non-farm payrolls. Forecasters expect that for the upcoming release, the number of added jobs will fall from 139,000 to 129,000, mainly due to corporate caution, triggered by the continuing economic tensions connected to tariffs. The unemployment rate, according to many experts, could remain at 4.2%, with wage growth inching higher. If these figures defy expectations, say the labor market shows an unexpected surge in hiring, some might interpret this as a sign that inflationary pressures could brew faster, prompting the Federal Reserve to keep rates higher for a longer period. This approach can often chill the crypto sector, as institutional investors may prefer safer debt or equity instruments. In a scenario of weak job growth, where the numbers do not meet forecasts, pressure can mount on policymakers to ease financial conditions, ushering in a more favorable environment for digital assets. It is a high-stakes cosmic balance where data that used to matter primarily to stock traders can set the stage for dramatic booms or busts in the cryptocurrency realm. Where does altcoin volatility fit into this puzzle? Many altcoins, from emergent decentralized finance players to more established tokens, remain heavily correlated to Bitcoin's price dynamics. When large macro events move Bitcoin, altcoins usually follow, sometimes in exaggerated fashion. Take a theoretical scenario. If the United States releases shockingly poor job numbers and global markets anticipate an interest rate cut, Bitcoin's price might rally on renewed risk appetite. This surge could reignite interest in altcoins, with smaller tokens often seeing outsized gains. However, the reverse is also true. A strong job report might cause investors to anticipate tighter monetary policy, limiting capital flows toward the crypto sphere. That means the next non-farm payrolls announcement is not just about counting how many Americans got hired in the previous month. It is a potential clarion call that can shape crypto headlines for days or even weeks. ADP, the private payrolls reporting service, will publish its own figures on the Wednesday preceding the official government data. Although ADP's numbers do not always perfectly mirror the final non-farm payrolls figure, they often serve as an early taste of the possible direction. So, if ADP's estimates are especially robust or starkly weak, speculators could start positioning themselves in crypto accordingly. Then, the Bureau of Labor Statistics will release job openings data, which could further refine or reshape market sentiment. All these seemingly bland bullet points are the bread and butter of foreign exchange traders, stock market pros, and bond investors. But in the fast-moving crypto space, each of these events can magnify daily price ranges in wild ways. Now, if you are already captivated by this interplay between government data and crypto markets, then you will want to hear what is coming next because it gets even more intriguing. The second big storyline circulating among investors this week is about crude oil and those who control its spigots, the OPEC Plus alliance. This cartel, which includes the Organization of the Petroleum Exporting Countries and its select partners, meets regularly to discuss and determine how much oil its member states will produce. Think about it. Oil is the lifeblood of entire industries, a key factor in shipping, manufacturing, and virtually every corner of the global economy. Changes in its price can alter inflation rates, prompting central banks to follow certain monetary paths. Again, that means interest rates. And again, that can feed directly into how confident or hesitant large institutional players might feel about pumping money into Bitcoin and other cryptocurrencies. Over the past several months, OPEC Plus has incrementally increased its production targets, and many analysts expect another boost, possibly in the range of 411,000 barrels per day in the coming cycle. This push is meant to seize more market share, especially as various conflicts in the Middle East appear to settle, opening the door for previously constrained producers to ramp up. Clarity over Iran's production potential also looms over the group's decisions, as expansions in Iran's exports eventually influence the broader supply-demand balance. So, does that mean we are heading toward oversupply in the oil market and thus cheaper crude? Lately, both Brent and West Texas Intermediate have dipped slightly, partly because of an end to certain hostilities in the region. If prices continue to drop, it might ease inflationary pressures, offering central banks an argument to lower interest rates or at least pause further increases. In that set of circumstances, the crypto crowd might sense an opportunity, fueling a new wave of speculative fervor. Alternatively, if OPEC Plus surprises us and decides to hold or cut production, perhaps a more remote possibility, oil prices might spike, intensifying inflation concerns and leading central bankers to keep or raise rates. That could weigh on crypto values. Notice how each of these pieces of news, non-farm payrolls, OPEC Plus, interest rates, becomes a puzzle piece that slots together to create a mosaic of risk sentiment. Traders, whether they specialize in bond markets, commodities, or crypto, are constantly scanning these developments, adjusting their positions, and triggering shifts in capital flows on a moment's notice. If that was not enough, we have a third big story brewing, one that might sound more explicitly political: the next tariff deadline. Tariffs have been a recurring theme for economies across the globe for several years, as world leaders negotiate or clash over trade policies. The emphasis is on whether the United States will impose or delay new tariffs on key partners such as Japan, South Korea, or the European Union. These measures can drastically alter supply chain costs, corporate profits, and consumer prices, which once again tie back into inflation trends, potential interest rates, and, by extension, the crypto market's liquidity. You could see the pattern forming. With these big macro developments, it is more than just describing the typical day on the trading floor. This is about how the entire web of economics intersects with the future of digital assets. If a new tariff deal emerges, like the agreements previously struck with China and the United Kingdom, that can spark a wave of optimism, encouraging risk-taking in everything from stocks to altcoins. A big reason behind that shift in sentiment is the so-called risk-on environment. Whenever significant economies come to mutually beneficial resolutions, it reduces the level of uncertainty. When risk goes down, some traders are more willing to place bets on the higher volatility corners of the market. This readiness to speculate can drive up demand for cryptos. On the other hand, if negotiations unravel, that uncertainty can slam the brakes on risk-taking, punishing crypto prices in the process. Traders will be waiting with bated breath around July 7th, the date the next wave of tariffs becomes relevant if no deals are made. If you are appreciating these insights, feel free to show some love by leaving a like. Your vote of confidence helps keep this kind of deep investigation alive. But let us not forget the final major catalyst lurking in the background: token unlocks. In the crypto realm, it is relatively common for new projects to distribute their tokens according to a vesting schedule. This means that at fixed intervals, sometimes monthly or quarterly, a certain number of tokens are released to developers, investors, or other stakeholders. When these tokens get unlocked, they become liquid in the broader market, and that sudden increase in supply can potentially weigh down the token's price. Picture a scenario where previously scarce tokens become more widespread, and some recipients decide to cash out. That downward pressure can ripple through the entire altcoin space, especially if we are talking about a heavily anticipated project where large sums are at stake. This week, several known projects are scheduled for token unlocks, including Origin Protocol, Maverick Protocol, Adventure Gold, Gravity, Navi Protocol, and Alchemy Pay. If you think new token supply might be a mere footnote in a market with thousands of tokens, think again. Observers have watched how certain token unlock events in the past sparked big sell-offs, especially if market sentiment was already cautious. On the other hand, some projects see unlocks as an opportunity to publicize new developments, showcase adoption metrics, or encourage more community participation, sometimes mitigating the usual selling pressure. You might be asking, can these token unlocks overshadow the macro complexities of OPEC Plus and nonfarm payrolls? Typically, the macro stories involving interest rates, inflation, and global trade produce the bigger waves. But for those laser-focused on altcoins, a sudden flood of fresh tokens hitting the market can indeed become a major plot point. This is particularly relevant for tokens that have smaller market caps, where additional supply can drastically shift the equilibrium between buyers and sellers. If overall crypto sentiment is bullish, maybe because of a weaker non-farm payrolls report or new tariff deals, then these unlock events might not be as damaging. Conversely, if the environment is already risk-averse, a token unlock can become the tipping point for a price meltdown. Now, let us talk about a crucial historical trend that also plays into this swirl of narratives: the month of July. Traders have noted that July tends to be historically favorable for Bitcoin, boasting an average monthly return of around 7%. That statistic, while not a guaranteed prophecy, has earned July a reputation as something of a bright spot in the annual Bitcoin cycle. Could this year follow suit, giving a breather to exhausted traders and reigniting a bullish spree that breaks that tough barrier at 107,000? Or will the weight of macroeconomic stress, ballooning inflation worries, uncertain tariffs, and giant production decisions overshadow any historical pattern? Keep in mind that in the wild west of cryptocurrencies, historical patterns can be upended in a flash. While many cling to the notion that seasonal patterns repeat like clockwork, citing conventional financial market rhythms, crypto has always been more volatile, more unpredictable, and more prone to black swan events. Still, illusions or not, if enough market participants believe that July is a bullish month, that belief alone can transform into a self-fulfilling prophecy, especially if other catalysts align to signal a green light. Indeed, the psychology of the marketplace is often as powerful as the fundamental data behind it. As we move ever closer to these pivotal moments, non-farm payrolls data, OPEC Plus decisions, tariff deadlines, and token unlock events, a lot of eyes are also on the uptick in Bitcoin and Ethereum exchange-traded fund inflows. Institutions and retail investors alike Continue watching every sign of acceptance from mainstream finance, every whisper of potential financial oversight from governmental bodies, and each ripple in the global economy that might shift capital. It is hardly a matter of fortune-telling. We are witnessing a multi-layered puzzle in which each piece, from the job market to the oil supply, from trade negotiations to token releases, can reinforce or unravel the tapestry of bullish or bearish momentum. We arrive, then, at the critical question: are you prepared for the volatility that might unfold? That is the magic of the crypto world. No single statistic or event holds ultimate sway. Rather, each subtle shift merges into a complex wave, carrying traders and observers along for a thrilling, occasionally terrifying journey. These upcoming catalysts form a veritable storm of pivotal data releases and decisions, any one of which could tip the scales in the near term. Will the job picture in the United States come in too strong and spook markets into anticipating more rate hikes, thereby putting downward pressure on crypto? Will OPEC Plus finalize a production increase that unexpectedly rattles the energy sector and edges inflation higher or lower? What about a last-minute tariff deal that revives a global sense of calm and sets traders free to pursue more volatile assets? And let us not forget the unstoppable countdown to those token unlocks, quietly threatening to inject fresh supply into the altcoin ecosystem. If you find this swirl of macro data and crypto twists exciting, consider subscribing so that you never miss another in-depth exploration of the factors shaping your digital investments. To stay on top of it all, you need to watch for each piece of news. Keep an eye on how the labor market numbers might shift the Federal Reserve's stance. Glance at the frequency of statements coming out of the OPEC Plus meeting. Will they confirm the rumored production booster? And definitely make time to check updates on any ongoing trade negotiations. With the next tariff deadline fast approaching, tension is sure to spike if progress stalls and those tariffs kick in for real. Meanwhile, take a careful look at the upcoming token unlock schedules. If you hold any of those tokens or are thinking of buying at a price dip, knowledge is half the battle. We often emphasize that crypto markets move quickly, but the truth is that they do not move in isolation. The entire economy, from job security and consumer spending to shipping lanes and trade balances, weaves a web that touches Bitcoin, Ethereum, and all your favorite altcoins. A slowdown in hiring in the United States can translate into interest rate adjustments, which can affect the global flow of capital, which can shift sentiment about crypto, which can then trigger surges or sell-offs. Similarly, a big yield in oil supply can bring down energy costs, theoretically fueling more growth in certain industries, or in an alternative scenario, triggering tough stances by central banks that might hinder crypto speculation. Like an enormous machine, each gear in the system, jobs, oil, tariffs, tokens, turns in response to the movement of the others. Once you see the entire mechanism, you can plan a strategy that accounts for the possibility of short-term volatility, or that patiently waits for longer-term trends to manifest. If you are more of a short-term trader, you might relish the kind of energy that these catalysts bring. Each surprise statistic or policy shift can create instant opportunities for those nimble enough to react. On the other hand, if you lean toward a more fundamental long-term investment style, these events can serve as checkups on the broader economic ecosystem that supports or undermines your faith in crypto's future. Many wonder whether Bitcoin will manage to break free from the gravitational field at 107,000. That level has acted like a formidable fortress. Bears hold it from above, while bulls keep rallying up to it, only to see repeated rejections. Some argue it is just a matter of time before we witness a decisive breakout. Others claim that without a broad-based risk-on environment and some clarity from the Federal Reserve, there is not enough momentum to push Bitcoin to new milestones. Strong arguments exist on both sides. Ultimately, the next wave of data, from production quotas to job creation, from tariff agreements to altcoin supply expansions, could tilt that delicate balance. So, what does the big picture suggest? We have at least 4 large events coinciding within a narrow window: the nonfarm payrolls data, the OPEC Plus meeting, the July 7th tariff deadline, and multiple token unlocks. We have all the makings of a perfect storm, or perhaps a perfect golden hour for those who are prepared. Crypto watchers are bracing for sharper moves in either direction, with many planning strategies that factor in breakouts or breakdowns. Regardless of which direction the market moves, expect plenty of drama. That is the nature of crypto. The only constant, ironically, might be uncertainty. And remember, if July is historically a month when Bitcoin tends to climb, a supportive macro environment during this pivotal stretch could accelerate gains, luring new participants who have been waiting on the sidelines. But if July's historical pattern fails to play out, or if unexpected developments slam the market, the disappointment could be just as rapid and severe. In the end, you, the savvy observer, hold the key to making the most of these shifting tides. You will watch the job numbers. Do they come in at 129,000 or surprise with a bigger or smaller figure? You will follow the OPEC Plus outcome. Does the group produce more or hold steady, fueling calmer or more anxious speculation in the process? You will track the tariff negotiations. Does the United States sign more deals that reduce tension, or do these talks fall apart, igniting fresh uncertainty? And you will keep a close eye on the token unlock schedule. Will the extra supply weigh down prices, or will investor optimism push these tokens to new highs? Above all else, keep your mind sharp and your strategies flexible. The signals from these events may reinforce or conflict with each other, creating waves in the crypto ocean that seasoned participants embrace as opportunity. By staying vigilant, connecting the dots, and respecting how each event can bend or shape the risk landscape, you can roam more confidently in the exhilarating realm of digital finance. Whether you cheer for an unstoppable Bitcoin or hold a bag of altcoins ready to soar in the next mania, understanding this chain reaction of catalysts is your best defense and your greatest advantage. That is all for now, but the story is far from over. In fact, it is just beginning. Will we see a powerful bullish turn, or could the market slip into a deeper slump? Keep your eyes locked on the horizon, and remember to brace yourself for turbulence. The next few days will be telling indeed. Our unveiling of these catalysts is only a snapshot, yet each piece is about to drop in real time, shaping the world of digital assets in ways we may scarcely anticipate. Stay curious, stay informed, and who knows, you might just find that sweet spot between caution and opportunity that turns a casual market watcher into a victorious crypto explorer. Good luck out there, and if you enjoyed this journey, hit that subscribe button for more in-depth investigations and thrilling market stories. The future of everything digital could hinge on what happens next.